Today I want to have a look at Lilly, which over the past 5 years is up by 580%. Now the reason why this company is up by so much over the past 5 years is that it is the main producer of the weight loss drug alongside with Novo Nordisk. And so today I want to figure out if this insane rise in price is rational and if the company is set to keep rising over the next few years or if it will fall. Now right away we can see that Lilly is a dividend company. They currently have a dividend yield of 0.64% with an extremely high trailing free cash flow payout ratio of 94%, which leaves them only with 6% of their free cash flow to push into innovation, which is very little for a company that operates in the healthcare sector. Now moving to the 9-pillar analysis, we can see that it's not looking too well. The rating is sitting at 4 out of 9. Now we can see the very high price to free cash flow of the company over the past 5 years and their very high PE ratio. Now if we have a closer look at these two, we can see that the PE ratio is actually currently higher than the 5-year average, and the price to free cash flow is actually sitting at 924, which means that investors are paying almost $1,000 for a single dollar of the company's earnings. Now we can also have a look at the growth of the company. Their revenue has been growing at a rate of 13%, but their free cash flow has been decreasing at a rate of 9.5%, and their net income has been decreasing at a rate of 10%. Now we can have a closer look at this. We can see indeed growth in the revenue, but the net income and the free cash flow are both decreasing, so it's not looking too good with Lilly. Now their 5-year profit margin is nice and high, and they have decreasing shares outstanding. Now normally I'd be happy for a company to decrease their shares outstanding, but with Lilly that doesn't really make sense as they are trading so expensive compared to their free cash flow and their earnings, and therefore it would make more sense for them to sell out shares and generate that free cash flow they so much need. Now we can see they also have consecutive dividend growth sitting at 14.30%, which I really don't think is sustainable in the long run based on the things we saw. And finally, the long-term liabilities over the 5-year free cash flow negative dividends is sitting at 1.64, which is a decent value. But if we have a closer look, we can see that in 2024 they actually increased them by 44% to 35 billion. And now we can finally calculate the intrinsic value of the company, first using the Graham's formula revised, where I plugged in the earnings growth estimate of 34.81%, and that still isn't enough to get the intrinsic value over the current trading price, so we get an intrinsic value that is 86% lower than the current trading price. Now moving to the next valuation model, I plugged in a future growth rate of 12% and a discount rate at 4.4% and got an intrinsic value of $665.96. Now for the third valuation model, we compare Lilly to 3 of its competitors, and based on their PE ratios, we get an intrinsic value of only $161.11. And that shows us that Lilly really does have an extremely high PE ratio. And for the final model, the dividend discount model, we plug in a projected growth rate of 6.67%. Now due to this being higher than the discount rate, we have to use our alternative model where we get an intrinsic value of $926. And now finally, we will average out all these 4 valuations and get an ultimate intrinsic value of $547.68, which is 32.66% lower than the current trading price of the company. Now based on this valuation, I really don't think that Lilly will manage to sustain their current trading price. I rather think that they will fall in price during the next few months or years. And with that, if you enjoy this valuation, make sure to leave a like and subscribe as it really helps me out.